Hello everybody, I'm Steve Cassaday, founder and chief executive of Cassaday Company. It's my pleasure to bring you our briefing on the 2024 elections and the impacts on investments and the economy. There are several questions right now on the minds of investors. Number one, who will win? Now, as you know, we have contempt for broad predictions. They are at best inaccurate and difficult to rely on when formulating investment policy. More importantly, all major events that have had a significant impact on the markets have been a surprise and were not predicted. This is axiomatic in that if the opportunity or a risk were known and clear, the markets would immediately react to it. Accordingly, barring the possession of insider information or advance notice of an event, it is impossible and dangerous to position portfolios for outcomes that might not materialize. Investing based on predictions is a big gamble. But what are the experts saying? Remember this, pundits predict because they are asked, not because they know. When equally credentialed experts have diametrically different opinions on the same subject, it calls into question the reliability of all such opinions. Now here's one of the many examples of experts being totally wrong. And this concerns the 2016 election, but I think it brings home the point. On the left, you see the anticipated results if Donald Trump were to win the presidency from the punditry, including from left to right, Citigroup, David Tepper, Société Générale, a French bank, Ray Dalio, the manager of the largest private equity company in the country, and Paul Krugman, the esteemed economic expert from Princeton University. And the ranges go from down 4% to down 30% if Trump were to be elected. But the reality on the right side of the graph shows the 1, 5, 1 month, 6 month, and 1 year returns of the stock market, which vary from 1% to 21%. So had we relied on the experts during this instance in the 2016 election, we would have left significant money on the table. But what about the polls? Well, polls have not always been accurate or reliable. And according to Yahoo Finance, election polls' historical accuracy has been spotty at best. In a 2023 examination of hundreds of U.S. election polls dating back to 1998, 538.com found that pollsters accurately predicted the winner only 78% of the time, and in 2022, they did so in just 72% of the races. So especially with a race this tight, it is impossible to know with any certainty who will be the next president. Assuming we knew who the president was going to be, what will their policies be? Unfortunately, campaign platforms, to the extent that they can be discerned, are rarely implemented after the winners take office. When it does happen, the finished product usually bears little resemblance to what was discussed during the campaign. Although there have been exceptions, betting on outcomes and making investment decisions based on campaign promises is not advisable. Do the markets do better under Democrats or Republicans? Well, consider this. What if one hypothetical investor had only invested during Republican control and another hypothetical investor had only invested under Democratic control and a third remained fully invested over the last 70 years? What would the results have been? As many of you know, I am a psychology major, so I'm not really great with numbers, but I think that this green line is a lot better than the orange line or the yellow line in this graph. The green line represents remaining fully invested since 12/31/1953 versus only investing when Democrats are in office or only investing when Republicans are in office. The difference, as you can see, is quite profound and supports our guidance, which is you should remain broadly diversified and fully invested all of the time. Clearly, staying invested has historically been a much better choice. Timing decisions made based on who is in power have dramatically eroded returns. Investing should be bipartisan. Stocks tend to go up over long periods of time, irrespective of what happens in Washington. Remember, people care about elections, but markets do not. Historically, pre-election anxiety is usually a result of the inherent uncertainty of the process. Markets do not like uncertainty, and this can lead to choppiness. The chart below shows 40 years of pre- and post-election day activity. Post-election 1-year average returns are 10%, with only a few being negative. This rebound is a result of lower level of uncertainty. Although not a guarantee of future results, this may mean the remainder of 2024 and 2025 could be positive for our portfolios. Key takeaways from our presentation today are: number one, politics has very little to do in the long run with what happens in the stock market. Number two, it will be very difficult, if not impossible, to predict outcomes of this election. Number three, campaign promises and policy implementation have historically been very different from one another. So in conclusion, remaining fully invested and broadly diversified continues to be our guidance. We hope you found our presentation to be interesting and informative. And remember, we are never too busy to discuss your portfolio or your financial plan in person or virtually. Please do not hesitate to contact us with any questions, comments, or suggestions. Thank you and enjoy the rest of your day.